Okay, so you see a stock price flashing on your screen. Let's say it's $50. But is that what the company is actually worth? We're going to dive into that because honestly, understanding the answer to that question is probably the single most important concept in all of investing.
So, let's just ask it straight up. Is a $50 stock worth $50? Well, the short answer is maybe. But, probably not. See, the number you see on the screen, that's just a price. It's not the value. And in this explainer, we're going to break down exactly what that means.
Think of it like this. On one side, you've got the market price. This is what you pay right now, today. And it's often driven by, well, feelings, mood, news headlines, short-term momentum. But on the other side, you have something called intrinsic value. And that is an estimate of what the actual business underneath it all is fundamentally worth. It's the old saying, right? Price is what you pay, value is what you get.
All right, so this brings us to our first huge idea. Price isn't value. And to really get this, we have to stop thinking about stocks as just little ticker symbols bouncing around on a screen. We need to start thinking about them for what they really are, a piece of ownership in a real, living, breathing business.
I love this analogy. Think about it. Buying a stock is kind of like buying an apple tree. Now, what makes that tree valuable? It's not the wood, it's not the leaves, it's the apples it produces, right? Year after year after year. A business is exactly the same. Its real value comes from the cash it can generate for its owners over its entire lifetime. That's the core idea right there.
And there's a name for this, right? The technical term is intrinsic value. It's basically an educated guess, an estimate of a business's true worth. And it's based on all the cash it's going to spit out for its shareholders from this very moment until forever. So the big question becomes, how on earth do we even begin to estimate that?
Well, we do it with a mental model I like to call the value engine. It sounds complicated, but it's not. This engine just takes in three key ingredients, three levers of value, that really determine what a company is truly worth.
So the first lever is the current cash flow level. This is our starting line. How much cold, hard cash is the business generating for its owners right now? After it's paid all its bills and put enough money back in to keep the lights on and the machines running. This is its baseline earning power.
Okay, lever number 2 is the growth rate. You'll often see this written as a little g. This is all about the future. How fast do we expect those cash flows to grow over time? I mean, it's pretty obvious, right? A company growing its cash at 10% a year is going to be worth a lot more than one growing at just 2%, assuming everything else is equal.
And now for the third lever, and this one is absolutely crucial. It's the discount rate, or R. See, a dollar you get 10 years from now is worth less than a dollar in your hand today. Why? Because of risk and uncertainty. The discount rate is simply the return you demand for taking on that risk. The riskier the company, the higher the return you should demand, and so the less you're willing to pay for those future dollars today.
So let's just put it all together. Our value engine takes these three inputs, the cash it makes now, how fast that cash will grow, and the risk involved, and it runs them through this discounting mechanism to figure out what all that future money is worth today. The final output? A single number, our best estimate of the company's intrinsic value.
Okay, so that's the theory behind the value engine. A little abstract, right? Well, let's make it real. Let's see how it works in practice, because we can actually use a simple formula to put a real number on a company's value.
Okay, now don't let the math scare you off here. This is called the Gordon growth model, and it's really just our value engine expressed as a simple formula. Now, it's perfect for valuing stable, predictable companies. The ones whose dividends are expected to grow at a nice, steady rate forever. It's not the right tool for a crazy high-growth startup, but for those boring, predictable businesses, it's fantastic.
So let's plug in some numbers. Imagine we've got a really stable company that just paid a €2 dividend this year. We expect that dividend to grow at a steady 3% a year, forever. That's our G. And because it's so stable and predictable, we only require an 8% return for the risk we're taking on. That's our R. We plug those numbers into our formula, and boom, it spits out an intrinsic value of $41.20. Now this is where it gets interesting. If the stock is trading on the market for $30, it looks like a bargain. But if it's trading at $50, it looks way overpriced. And notice how sensitive this is. What if we decided the company was a little bit riskier and we demanded a 9% return instead of 8%? Suddenly, the value drops to $34. Your assumptions, they matter a lot. And that brings us to this really critical battle that happens inside the value engine, is the constant fight between growth and risk. We all just kind of assume that growth is good, right? More growth is better. But is that always true? So let's just ask the question directly. Does growth always create value for shareholders? We're taught to think so, but the answer is a surprising and really emphatic no.
And this chart illustrates exactly why. It's brilliant. Let's say a company earns €3 per share. If it has zero growth and we demand a 10% return, it's worth €30. Simple. Now, if it manages to grow at 2%, its value jumps to over €38. That's great. But look what happens if that growth is really risky, and to compensate, we now demand a 12% return. The value just plummets right back down to about €30 again. All that potential value from growth was completely wiped out by the higher risk. So here's the lesson. Growth is only valuable if it doesn't come with too much risk attached.
So, given that this whole process is based on our best guesses about a future that's fundamentally uncertain, how do you protect yourself? How do you keep from making a huge mistake? Well, this leads us to the final and maybe the most important takeaway of all, the investor's safety net.
It's a concept called the margin of safety, and it's super simple. It's just the gap between your conservative estimate of a stock's intrinsic value and the price you actually pay for it. So if you think a stock is worth €41, but you can buy it today for €30, you have a huge margin of safety. It's your buffer. It's your cushion that protects you when, not if, but when your assumptions turn out to be a little bit wrong.
You know, this entire framework, this whole explainer, it really just boils down to asking yourself 4 simple questions before you ever click that buy button. What are the real cash flows? Is the growth I'm projecting realistic and actually valuable? What are the risks I'm taking, and am I being paid enough for them? And, most importantly, does today's price give me a big enough margin of safety? Because ultimately, every stock price out there is telling a story. It's a story about that company's future, a story about its cash flow, its growth, and its risk. And your job as an investor is to use this framework to decide one simple thing. Is that a story you actually believe?